When mid and small cap stocks they go higher, markets say stock market में सट्टा हो रहा है, weak hands are buying into stocks. That's a bearish sign. That is a red light, so to speak. But when suddenly institutional investors they start buying mega cap stocks and large cap stocks, markets would say it's because of liquidity, and we should not get worried about it.
See, I think the benchmarking has definitely hurt. Benchmarking has definitely hurt the freedom of institutional investors to invest based on what they think will do well in the long term. So I think too much of benchmark hugging is happening. I would blame it on the way the mutual fund manages its fund managers and their performance internally. I think that that system is, sorry to use the word, it is rotten. So because of this rottenness, I think the investment approaches of many fund managers has become very near-term oriented. It's more job hugging. So I think that many of the people have lost the courage to move anywhere away from benchmarks or whatever are the performing parts of the benchmarks. So I think the investing is descending very much towards the ordinary while markets are rising.
What is your general view on the market and the economy? This market surely has managed to climb the wall of worry. Now we can argue whether earnings are strong or whether earnings are not strong. I mean, if you look at FMCG, earnings are strong. If you look at corporate banks, earnings are not strong. So depending on what your prism is, you will have a different answer. But are you pleasantly surprised that from bombed out levels, the recovery has been very strong and very, very swift and fast?
See, I think that again, the consumer space has done very well because of the base effect, the pre-GST slowdown in the market, the demonetization effect on the base. All these things have basically created a nice optical place for consumer. So I think that people have really paid 10-20% more based on the current earnings. I think that we should look for some more quarters before we conclude that it is structural. So I think the consumer space has run ahead a bit in the last few months. Again, this is driven by chasing performance, near-term performance. But there are other parts of the market which should benefit from whatever are the structural reforms done by this government in the last 3-4 years, which have really not translated into economic growth the way we would like it. But that reform will play out sometime over the next 2-3 years, and I distinctly see an unwillingness among institutional investors to go anywhere near it, except 1 or 2 fund managers. The rest are all really not willing to go anywhere near it because they don't see the near-term benefits of earnings. We are in a market and an economy where it should be more value-driven than growth-driven, because the growth anyway is paid adequately for. So I think that that adjustment has to happen, but I don't see will among institutional investors to make that adjustment and wait it out for 1 or 2 years and make much bigger money for the investors. I think that hunger and the risk appetite is very badly wanting.
Hi, morning. As I go through your notes, you're also warning investors to be careful of private banks. Expensive valuations, I believe, is one reason that you've cited. Do you think, aside of valuations, it's also a case of maybe money moving out of private banks, which have already run the course, has been great compounding stories for not just months, but years put together, and maybe money seeing a move towards corporate banks or even PSBs for that matter? As in the month gone by, the performance is indicative of the same.
So I see it as 2 parts. One is the money that has moved from the public sector banks to the performing private banks. But there's a more important part, which is the trade away from the non-performing private banks to the performing private banks. Like, you know, people have sold the Axis and the ICICIs of the world and put all their money in the performing private banks, which is your HDFC or Kotak and some others. I think that that trade has overdone itself, and I think that you know, at least the best case is a time correction, and the worst case can be painful even when people have bought good companies. I think we are forgetting our lessons from past cycles. You know, when you pay higher than you should, even for the best of companies, you will make either no money for quite some time, or you will make even a loss in the near term. I think that that is something that is beyond escape. And I think that that is something that we have forgotten. I have greatest respect for the performing private banks, but still there is only that much you can pay for them, and you cannot pay any value for a company. I think that's basically doesn't conform to sensible tenets of investing.
Where are we in the commodity cycle? I mean, with the slew of hikes that has been initiated by steel companies, it seems like, after 18 months, I think almost 24 months of an up move, there's still more in store for how these companies are positioned in the business cycle. They're not like, it's not like the cycle has peaked out just as yet.
See, one thing that you need to understand with respect to steel is that the government is definitely ring fencing our markets from the global market. So looking every day for news from China or global markets and then deciding our investment positions on the larger Indian steel companies doesn't make sense to me. I think that you have to read the steel policy, which is out in the open, in the public domain, understand what the government is trying to do, what are the policy initiatives done by the government in recent times, and how they are trying to ring fence the Indian steel market. I think that importing steel can have very serious impact on our trade balance and our, on the dollar rupee equation. So therefore, it is very imperative on the government to support the steel industry and make it supply more steel, most of the steel that we require, and reduce imports to the barest minimum. I think that this policy direction has taken serious proportion long back, and we are going to see this play out for quite some time. Interestingly, I don't expect political dispensations to matter in this area. I think that whoever rules India in the post-2019 scenario will continue with this policy framework. So this is something that provides reasonable visibility for the Indian steel companies who have already created capacity or already acquired capacity and are in a position to ramp up production to meet demand. And the story is only about who is equipped to ramp up production to meet demand that is coming up. And it is not very difficult to see that demand growth in India will be high single digit at least for the next 3-4 years for steel. So all these things augur well for steel. I think again, looking at metals as one basket or commodities as one basket is not making sense to me. I think that you should look at each item or commodity separately and understand the global dynamics, the industry dynamics, government policy, and which are the companies positioned to take advantage of all these things. So that is what one needs to do with respect to steel and all the other metals and commodities.
Shyam,